Hello, my awesome accounting students. Welcome back for the second day on Chapter 20.
Okay, so glad you guys are here this morning. We're going to talk about the second half of the budgeting chapter. And what we've done is we've started talking about the importance of managing your money. And we said that a budget is a financial blueprint of how you're going to get from where you are to where you want to go. And I used the analogy last time of my niece just jumping in her car and saying, let's head west and go to New York. She'd eventually get there, but it'd take her, 2 to 3 times longer. She'd spend 2 to 3 times as much money probably getting to where she wanted to go. And that's the importance of budgeting, because if you don't know where you want to go, you don't know the precise way to get there, you'll eventually get there, but it won't be in the most expeditious way possible. If you remember, and I don't have my notes in front of me, I'm remembering with you guys, we start with the sales budget. And that sales budget told us how many units we hope to sell and for how much. So that was the starting point of everything. And everything else is a drop down process. Then we did the production budget. And that was the only budget that had no dollars associated with it. And basically that production budget started out with the sales budget, and it added in ending inventory, and it took out the beginning inventory. And that gave you the number of units to produce. Okay, after that, to me, it's pretty easy to remember because we spent so many chapters talking about 3 product costs. And so that just falls down out of the production budget: direct materials, direct labor, factory overhead. And then in addition to that, we had our period expenses. So that would be the selling expense and also the G&A. And then one that we didn't add last time, a capital budget. Okay, you can read about that one. It's basically a budget that foresees what type of big purchases you're going to need in terms of plant, property, and equipment. Right. So if I knew that I needed to replace vehicles for 4 years down the road, then I would build that into my budget as well. We talked about almost all of those last time, except for the capital budget. So you can go back in your textbook and read about that. It's probably one of the easier ones. And then here's what we're talking about today. All those budgets flow down into the cash budget, which answers the question, do we have enough money to fund the operations that we're predicting is going to happen through this master budgeting chapter? So it's like a drop down effect. And if you blow the sales budget, you can see what happens. The rest of the budgets are going to suffer. In another chapter, we're going to learn about flexible budgeting. How do you flex forward a budget that has changed based on some external factor usually happening in the economy? So here's what we're after today, this cash budget. Do we have enough money to finance the operations as we want? Or if we notice that there's deficiencies, right? We notice that we don't have enough cash, you need to recognize that ahead of time. Like, I would not want to recognize that. There was a point where the company that I own or partially own, we paid 83 people. Okay, the time to realize that we're going to have a shortage is not the day before the payroll hits, right? Because that would be very, very stressful. The time to realize that is months ahead of time, so that we can go get a credit line from the bank, or we can go get some inventory financing, or we can go get a letter of credit. We can take advantage of these different options and not be so stressed out like we need the money tomorrow. That's not cool. We want to predict these things out months ahead of time. That gives us the ability to shop around for the best financing that's going to work for our business. So here's our agenda today. The cash budget is fed or supplied by all the other budgets. We're going to clearly see that today. It answers the question, how are we going to fund everything else? The cash budget is mainly made up of 2 major schedules. Because the cash budget is can be very, very sophisticated, A test question, I'm thinking, is more going to be along the lines between a schedule of cash receipts and a schedule of cash payments, because those are the foundational schedules that make their way into the cash budget. You'll see me demonstrate both today. So a schedule of cash receipts is going to show us how those sales that we budgeted up top, how is the money going to come in? And we're going to look at the history of collection patterns to estimate when the money will come in. And then on the flip side, we're going to take a look at the timing of the distribution. The direct labor budget, for example, people need to be paid probably weekly, maybe monthly, but we need to time out. Those are cash payments. Other payments that we might be able to float on credit, maybe accounts payable, let's say, might be half now and half later. Those are the timing issues we need to look at. And then again, the goal is to estimate when these excesses and shortages are going to occur so that we can make arrangements to best manage our cash. And one thing down here, this is so important, and a lot of people don't know what a debt covenant is, so I want to stop for a second. The other reason that we predict our cash out is because some banks, as a condition of loaning you money, will ask you to keep certain debt covenants. So let me just describe, if you've never heard that word covenant, it means a promise. So the first time we get exposed to covenants, my first time exposing that was, reading a Bible specifically. There's covenants covered in there. But a debt covenant is a promise that you make to the company that's loaning you money. And there's several kinds of debt covenants. The ones that I see most often is you guarantee to keep X amount of money in the bank at all times. So what that means is if you've signed a debt covenant saying that you agree to keep $30,000 in the bank at each time, and you break that, your cash drops below, they can call your loan in. The other type of debt covenant that I often see relates to like a current ratio. They'll tell you that as part of us loaning you money at this low interest rate, you guarantee that your current ratio will not drop below X. Maybe it's 2 to 1. So that's the other reason that you want to forecast out your cash so that you can calculate these debt covenants and make sure that your cash doesn't drop below or that your current ratio doesn't drop below that. Because you guys can imagine how stressful that would be if you think you are going to pay this loan off over the next 5 years and all of a sudden you break a debt covenant and the loan person says, okay, your cash went below 30,000. We can call your debt due. And you agreed to that when you signed off on the loan. That can be really stressful. So that's the other reason that we want to project out our cash. So that's where we're headed. Any questions along those lines? Okay, then this is the handout. Everything is in the modules link. This is the handout for the chapter. And I just scrolled down to, I think it's the last page, because I want you guys to think about your own bank accounts, right? Because that's how I remember what this looks like. I can relate it back to my own personal bank account. If I were to think of my regular checking account at Bank of America, I'd have a beginning balance and I would add in the receipts that I expect to get. In my case, it would be, for example, a paycheck from Cerritos College. That would be the receipts. I would add those in. And then I would take out all the estimated payments that I expect to make. How would I do that? I'd have a history of what my personal wise, what my grocery costs are, what my car payment is, what any kind of childcare expenses are. And you would subtract that out. Excuse me. Darn. So you start off with whatever your beginning cash balance is. You add in the receipts and you take out the payment. So again, thinking of your own personal account, if I were to ask you how much cash you're going to have at the end of the month, you'd take your starting balance, you'd add in the receipts, which for most of us would be some kind of a paycheck, and you'd take out all the payments that you normally make, and you'd have your projected ending cash balance. This is the balance that you want to compare to any kind of loan covenants or minimum balance requirements. So the work for us is going to come out in timing out these cash receipts, because remember how a business generates the cash receipts. You or I might get paychecks, and it's easy because we get paid on the same day. But companies are generating their cash receipts through the sales of their goods. So as that sales budget morphs, then we need to time out the payments. How do we get our cash in? It depends on what the excuse me, payment terms are. It depends on what the payment structure looks like, and it depends on how you pay your bills. For example, some vendors I may have 60-day terms with. Others might be 30-day terms, and others might be just a cash basis only because I get a big discount. So we need to learn the types of payment structures that these companies have, and that'll help us out with the projections. I think personally the best way to do this chapter is to just jump in and try the exercises. I think that's much better than looking at PowerPoints and so forth.
Okay, let's try this first one together. Kayak Company budgeted the following cash receipts, shown in this first column, and cash payments in the second column, excluding cash payments for loan principal and interest for the first 3 months. Okay, so one of the first things I always ask myself is what period of time are they looking at? Looks like they're looking at the first 3 months or the first quarter of the year. They require a minimum cash balance of $30,000. Okay, I would jot down a note to myself that there's a debt covenant, and it's important to never let our cash fall below that $30,000. Loans taken to meet this requirement charge 1% per month. It's kind of odd that they give you a monthly rate of interest. You'll usually see that expressed in a yearly percentage and have to divide by 12. But this time they told us it was 1% a month, paid at each month end. The interest is computed based on the beginning balance of the loan for the month. Any preliminary cash balances above $30,000 are used to repay the loan. This sounds like some type of a line of credit, and if they have more than $30,000 left at the end of the month, they'll use any excess to pay down their loan. Hopefully we have more than that, but that is a condition they gave us in the set of facts. The company has a cash balance of $30,000 as of January 1st. I'm going to pop that in first. And a loan balance of $60,000 January 1st. So we'll be making our first interest payment based on that $60,000 loan. So in the interest of time, I've put months across the top. I put our little preliminary cash schedule that we talked about in the lecture below. Again, think about your own banking account or checking account. We're going to start off with our beginning balance. We'll add in the cash receipts. I'm going to go ahead and I snipped this just so I wouldn't be driving you crazy by scrolling the screen up and down. So there's the $525,000. I think I'm going to go right across the way. $400,000 is estimated to come in February. $450,000 is estimated to come in March. And then cash payments, I'm going to show as negative amounts. And we notated that this does not include the interest payment. So $475, $350, and $525. The interest payment they mentioned was 1% a month. So the first month, they told us that our loan balance was $60,000. When we multiply that by 1%, whoops, let me get rid of that snip screen. Sorry about that. When we take that 60,000 times 1%, we'll get our interest payment in there. And now we're ready to start projecting out our cash. Okay, now that our total line's in there, we're ready to begin to summarize our cash projection. Let me put that first sum formula in. Recall that the author told us that if we had above 30,000, we would start to pay down that $60,000 loan balance. Because my cash has to be no less than $39,000, I have the ability to Because that preliminary cash balance is above $30,000, we can pay down any excess against the loan that we had of $60,000. Since the lowest amount we want here is $30,000, the difference between the two represents the payment to be made. So we took out the difference between the $79,400 and the $30,000 and put it here. Someplace we need to keep track of the loan balance. So for two reasons, so that we know how much interest to pay, and also so we know how much is needed to pay off. I'm going to use a simple T account that I've placed down here at the bottom. We started with $60,000 as the beginning balance, and we just paid $49,400. That would make that payable go down. Let me widen this so you can see it. So right now, I'll need this for the next month when I have to make another loan payment. Someplace on your spreadsheet, keep track of how much is owed so that you can properly do the remaining calculations. Right now, there's $10,600 owed on my loan. Just like at our own bank accounts, whatever we end today with, we start the next day with. At the end of this month, the cash balance was $30,000. That's going to be brought up to the top for February as our beginning cash balance, and we repeat the process again. So we just took a look at a T account that showed us that we owed $10,600 and our interest rate is 1% a month. So let me calculate that. $10,600 at 1% gives me a $106 loan payment. After fixing this payment amount and coming back on the video, I'm ready to sum this up. So let me sum from the top of February down to the bottom. Here is now our preliminary cash balance. Once again, the book told us that anything above $30,000 would be used to repay the loan back. Well, we clearly have more than the $30 minimum balance. So looking at this loan payable balance, I'm going to go pay that loan off with the additional funds that I have. I don't want to pay more than I owe, so there's the $10,600 that I owe on the loan, and I'm ready to compute my new cash balance by summing those up. I take that ending balance and go place it as my beginning balance. In fact, I'm going to just cell reference it so I don't make a transposition error. And I'm ready to do the same thing. I don't owe any interest because my balance is paid off. I'll just copy my footing formula over from the previous month. Now I have a deficit. Okay, this is the month that all business owners hate to see, when they don't have enough cash to pay for their expenditures that they've budgeted out. And this is where a line of credit can be literally a financial lifesaver. Here's the part that trips up many students. Remember what we promised the bank. We promised the bank that we would have no less than $30,000 in our account. So now it comes time to draw from the line of credit. But I'm not just going to draw $30,000. I need to draw $35,706. In other words, not only do I need to make sure that my minimum cash balance of $30,000 is in there, I also need to cover that deficit. So that's my budgeted draw against the line of credit. And to finish this up, we would foot this. And we have $30,000. Again, got a little bit of cleanup work to do with lines and so forth. But that gives you a little bit of practice with a preliminary cash budget. We haven't really addressed the tough part yet, which is timing out those cash receipts and cash disbursements. We'll get to that in another exercise. So practice, practice, practice. If that threw you for a loop, go in and try some other similar exercises. Let's move on to the next one. Okay, let's attack scheduling out the cash receipts. Remember the line item from the previous exercise that said cash collections or cash receipts. Well, this is how we would go about creating a supporting schedule that supports that amount. So this says Jasper Company had 70% of its sales on credit, that means on account, and 30% for cash. The first thing I do is make myself a little flow chart on how the cash comes in. So this would be coming from the sales budget. And what they told us is on their collection patterns, 30% of their sales are cash, which gets collected immediately right away. And the other 70% are on account. And their collection pattern indicates that in general, their accounts receivable is collected in full in the next month. In fact, the second sentence will reinstate or reinforce that concept. It says all credit sales are collected in full in the first month following the sale. And then they give you the sales budget, which I've put up here for informational purposes only. They also told us what the total sales for March were. Now, remember, since we're doing the budgets for April, May, and June, March would come into play. So that 500,000 that was sold in March, 30% of it would have already been collected through the form of cash sales. The other 70% would be coming in the next month, which is April. So let's start off by putting that collections on account from March sales. And I would leave myself a record of how you're coming up with these amounts. So that was the March sale of 500,000 times the 70% that was on account. That's the cash that came in April from March sales. Okay, so we have that in there. Now we're going to use these sales budgets to project out the rest of the cash. So I'm going to use color to help you see the stair-step approach. So I'm going to put those cash sales in the month of April and the collections from the April sales in May. You'll see what I mean when you see the stair steps starting to happen. So we're in the month of April. 525,000 was the sales budget, but only 30% of that came in right away. The rest of it, the other remaining 70%, came in the next month. So I'm just going to take the difference between total sales and the cash sales to come up with this amount. I think I put it on the wrong line. So let me move it up one. And again, I tell you, this is a school-issued computer and it gives me all kinds of problems with the mouse. Bear with me. Okay, so we have April down, and I would encourage you, as you're learning how to do this schedule of cash receipts, to use some color with highlighter pens or something, and always double check to make sure that the sum of these yellow boxes add back to the sales. Okay, that brings us to May. Let me change the color so you can see the step down approach that I keep referring to. I'm going to put color in the cash and color in the collections, and get yourself into the habit of double checking your work. So I'm going to take 30% of May sales as coming in cash, and then the remainder of it will come in the next month. You'll see again the colored stair-step approach. And then as far as June goes, there was 560,000 in sales. Let me put the colors. You'll notice that this last green is what we call off the schedule. In other words, that would come in July, but just so that you could see how the stair step works, I'm including it kind of off to the side. So our June sales were 30% now, and the remainder later in the next month. So I'm going to go ahead and complete that schedule. Now they only wanted the schedule of cash receipts, so I will put in total projected cash receipts, and all I want to do here is add up from the top to the bottom. I'll let Excel do its magic. I'll copy that formula across. Got a little bit of cleanup work to do with total lines, but I think that more importantly, you can see the logic behind scheduling out the cash receipts. So if you think back to the previous exercise, we would have a supporting schedule that supported the cash coming in the cash budget. I would expect you to be able to do something like this on the next exam. I would even expect you to have a little bit more realistic collection pattern where maybe half of it comes in the month of the sale, and maybe a quarter of it comes in the next month, and the rest of it comes in the following month. Most businesses don't get all of their cash within 1 month. And so, again, this is a survey class. This is an introductory problem on scheduling out cash receipts. You should be expected to dive in deeper, and you can even create your own problems to work out in preparation for the upcoming exam. Let's move on to the next one. Along the same lines is a schedule of cash payments. The goal is to schedule out the timing of the cash payments, and once again, this supports a line item on the cash budget that we started off the day with. So let's read and then we'll work on this together. It says Zisk company purchases direct materials on credit. Budgeted purchases are, and they give us April, May, and June. Okay, I went ahead and wrote those in on our schedule. And then they're going to tell us the timing of these payments. It says cash payments are 70% in the month of the purchase and 30% in the first month after the purchase. You could write a little flow chart down if you wanted to, but as long as we have this to go back to, some of you may not need that flow chart. And because we're looking at April, May, and June, they also told us what purchases for March were. And you may be asking yourself, why is that relevant to this budget for April, May, and June? What's relative is the portion that was paid in April. So according to the diagram that they gave us, it says that 30% is paid out the month after the purchase. So I'm going to go ahead and use March's sales. And even though the month of purchase doesn't fall on our schedule, the month after the purchase would certainly be relevant. So the $70,000 of purchases that occurred in March, 30% of that would be paid in the following month. So let me go ahead and compute that. And we'll start fresh with the data for April, May, and June. 70% of April sales would be paid for in the current month. So I'll go ahead and multiply that. And the rest of it would be paid for in the following month, which would be May. And we just keep pushing it forward. For May, 70% of that would be paid in the same month, and the remainder would be paid in the next month. And we repeat for June. 70% of June sales would be paid in June, with the remainder again paid off the schedule in July. Again, I just included July so you could see that stair-step approach. They wanted the total budgeted cash payments. We would get a total line in there just for the 3 months in question. Sum those up. And then compare your answer to mine and see if you're able to do a simple cash projection. Again, practice makes perfect. If you get stuck on any of the items we're talking about, reach out to your tutor or reach out to me. Let's move on to the next. Okay, here's some more practice on a cash budget. Very similar to the one we started the class off with. I wanted you to see how the cash receipts and how the cash payments were derived. So I put a similar problem before that lecture and after that lecture. So Kareem Corp requires a minimum $8,000 balance. Keep that in mind. We don't want our cash balance to fall below $8,000. Loans taken to meet this requirement cost 1% per month. Again, kind of unusual that they give us a monthly rate, but they did. Any preliminary cash balance above $8,000 is used to repay those loans at month end. They give us a starting cash balance of $8,400. I'm going to go ahead and drop that in while we're thinking about it. And the company has no loans. So right now, their loan balance is zero. That means there will be no payment required for the first month. That may change depending on whether we need to draw against that probably line of credit. Budgeted cash receipts other than for the loans received and budgeted cash payments other than the loan for interest follow. And our goal is to prepare a cash budget for July, August, and September. Again, first thing I want to impress upon you is that we need to get the format down for this. So think back to your personal accounts. We have a starting balance. We add in a projected receipt. For most of us, that might be a paycheck. We would take out our estimated payments, and again, that excludes interest. We'll have a separate line item for interest, and we know in the first month it will be zero because there were no loans. We'll come up with a preliminary cash balance, a reminder that we need to be above $8,000, and then we will either draw money on our loan, which means take money out to increase a loan payable if we're below that $8,000, or if we have an excess, we could make a payment against that loan, and that'll give us our ending projected cash balance. So one of the most important items, in fact, one of the more difficult items, is the cash receipts and the cash payments. They gave that to us. So I'm just going to copy that down. 20,000 cash receipts in July, 26 in August, 40,000 in September. And let me widen these columns so that you can see the amounts. Let me get that last one in. And then the projected cash payments, I'm going to enter with a minus sign in front of them simply so Excel, which I'm using on this schedule, can automatically know that that's subtracted out. So again, I'm just copying from the schedule they gave me. And it's a little annoying when the columns aren't wide enough, trying to keep everything on the same screen for the video here. The interest, we know in the first month there was no loan, so we're ready to calculate our preliminary cash balance. Let me put a total, oops, I did not want to use that box. I wanted to use my borders box, which gives me a much better choice of lines to use. So let me go put the bottom border in. Let me sum this up. And once we have that first summation, and if you're using Excel, you could copy that across. And we see that at the end of the month, we only have 400. We know that our balance cannot drop below 8,000. So we're going to have to borrow some money against our credit line in order to bring that 400 up to 8,000. So if this is the goal, to have 8,000 in there, then we need to draw the difference between that amount. So 7,600 is the amount. I would keep track of your loan off to the side, maybe in a little T account. Right now we owe $7,600. In fact, I might as well go in there and put in the payment of interest. That would be the $7,600 that we just drew on at 1%. And I would like a minus sign in front of that so it's taken out properly. So that was just kind of a side, fill it in as you go. So let me get back to where I was. That $8,000 that exists at the end of the month of July is going to be our starting balance for August. So I'm going to put an equal sign in. I'm going to go grab the 8,000 and press enter. And now I'm ready to recompute the cash balance. I'll go ahead and use my same formula. So in the next month, I have a preliminary cash balance of $3,924. Again, it needs to be $8,000. So this is another balance where we find ourselves a little short. We're going to have to borrow against our credit line. I need this at a minimum to be $8,000. So I'm going to go ahead and compute the difference between those two to come up with the amount that belongs there, $4,076. Let me fix some lines while I'm down here. Okay, so now we owe a loan balance. It is the sum of these two. So we might as well go up and put in that loan payment. I'll go ahead and calculate my loan balance. It is $7,600 plus the $4,076 that we just drew against it times 1%. I'll go ahead and fill that payment in. I believe they had you rounding to the nearest whole dollar. I'm not going to worry about that right now. We'll just keep going. And so now I am ready to pull that cash balance up and complete the problem. So my ending balance of the previous month is my starting balance for the next one. Let me go grab that. And now we can go ahead and recompute our cash balance. Make sure that your recomputed cash balance matches mine. In this month, this is what the owner likes to see. We do have a suggested excess, and any type of excess that we find ourselves having, we will use to pay off the loan. So to wrap this up, since we have over $25,000 and we are required to have $8,000, we would pay off the principal of this loan with any remaining excess. Let me go ahead and sum that up. The sum of those two balances, since we've made no principal payments against it, that would be the total loan payoff to bring our loan balance down to zero. And that means our ending cash balance would be as you see on the screen. Once again, if you are struggling at all with coming up with those correct answers, do a few extra ones to increase your confidence until you feel like you could do something similar on the exam. On this next problem, it's a little bit simpler in that they provided almost all of the numbers. What may be challenging for you is letter C, where they are going to tell you how they want the payments for direct materials timed out. I also wanted to point out letter E. Sometimes the author will throw you a curveball, so take a look at letter E with me. Depreciation expense is a non-cash expenditure. Depreciation expense, as you will recall, is the cost of an asset less its salvage value charged out over the life of the asset. It does not represent an expenditure of cash, and so when it comes to letter E, on the budgeted depreciation expense, you should cross that out. It is not relevant for a cash payments budget. Actually, this is a cash budget in general that the author is asking you to do. So once again, if you see some type of an accrual or deferral like depreciation that does not involve cash, you would ignore it or omit it from the cash budget. I'm going to pause the video and give you some time to work this out. Let's come back and compare the answer. Let's see how you did. As far as the setup, we should see a beginning balance, we should see cash receipts added, and we should see all the various payments subtracted. Most of the information was given to you. Double check the payments and make sure that you calculated the payments for direct materials correctly. Also make sure that you did not include letter E. For note-taking purposes, I included it with a blank amount to remind you that depreciation expense is not a cash cost. If you came up with an ending projected balance of $124,500, congratulations, you did it right. Now let's move on to the mother of all problems, the hardest one we will do in this chapter. Read it with me, and then we'll plot out a plan of attack. This last question is probably the toughest one that we'll do in this chapter. Take it apart piece by piece and let's develop a plan of attack. So it's a manufacturing company. They're preparing their master budget. Budgeted sales and cash payments follow. So the budgeted sales, one of the tougher parts is developing the schedule of cash receipts, which is the first requirement in this problem. So take a look at how their cash comes in, and that would be the thing I would start off with first. Sales to customers are 20% cash, and the rest is on account. And someplace they'll have to tell you how the cash comes in. Go ahead and read through that. In fact, they told us all credit sales are collected in the month following the sale. So do that schedule of cash receipts to get you started, and then we'll take a look at how the cash goes out. Pause the video and try the schedule of cash receipts. Here's the schedule of cash receipts with coloring added to help you with the calculations. You'll notice that the author asks us for July, August, and September, but to help you visualize what happens at the front end and the back end, I've also added June and October kind of off the schedule. They gave us June sales, and based on the collection pattern, 20% of that would have come in the month of June, but the rest of it would have affected the months that your author was concerned with. So take a look at your calculations, compare them to mine, and then give the schedule of cash payments a shot. We'll come back and compare our answers. Once again, lots of help is available. You just have to ask for it. Go try the schedule of cash payments and we'll come back. Looking at the schedule of cash payments here, everything in this problem was given except for the sales commission, which was computed at 10% of sales, as well as the interest payment on the loan balance that you'll see here in yellow. I left that line item open so that we could calculate it together. I left the interest line item blank so we could calculate it together. At the start of the problem, the author told us that there was a $2,600 balance in loans payable, and the interest is 1% of that balance. So to start us off, let's take that $2,600 and calculate that interest at 1%. Okay, once we do that, we get our cash payments balance and we're ready to update our cash payments down here. Now we got a preliminary line item balance of $12,914. The problem told us that the minimum balance was $12,900. That means we have a little bit extra, and any extra amount over that amount, we were instructed to pay down the loan. So not a whole lot to pay down, just $14 here, and that'll give us our ending cash balance at the end of July. Let me take a moment and go update my loan balance because shortly we'll be asked to make another interest payment. So let me put a total line in here, calculate our new loan balance. We just paid a little bit off, and $25.86 is our balance now. So back to our schedule of cash payments, that $25.86 needs interest paid on it. $25.86 times 1%. Again, the connect directions will probably be to round that, but I'm going to go ahead and leave it as is in this calculation so you can see how the math works. That means I'm ready to bring my balance forward. So I'm going to take the ending cash balance from July to start off August. I've put in my cash payments, and now I'm going to go grab my cash payments now that it has been updated with interest. I'll sum that up using the formula that I built into this. And now we have an excess well above the $12,900 balance they wanted us to keep. So I'm going to pay my loan off. My full balance on the loan is $25.86. I'm going to go pay that balance off. I'll show that I just made that payment so that my balance in that loan account is now 0. Let me widen that column so you can see that number. And then it's just a matter of doing the math and rolling it forward. The budgeting process is often a roll forward process. So here's my ending balance. I'm going to carry that up to September. I don't have a loan balance, so my interest will be 0. That means I can go put my final cash payments in. I'll update my cash balance. There is no line of credit or draw that I need to worry about. I'm well over the requested minimum balance, and so that will be also my ending September balance. Okay, again, this is a survey class. This was a fairly easy problem in that we didn't have to schedule out a bunch of payments. However, it's a good problem to practice prior to the test because the test problem will be probably worth 10 points or so, but it probably won't be as detailed as this problem because of time constraints. I am aware that Connect shows the budget in a different format, so to wrap this problem up, here is the Excel solution. I prefer to see a much more summarized final cash budget, but I am providing the answer so that you have a guide to do your homework in the way that the author intended. That's about it on the cash budget. A lot of detail. In my own personal opinion, not too much difficulty because of the way that they gave you pretty much most of the payments and receipts timed out. They made you work a little bit, but in real life, the cash budget can take hours, if not weeks, to pull all of the information together. This is Professor Johnson signing out.